Good morning, friends. I am going to give the information on Basel Accords, Basel I, Basel II, Basel III. These are the set of international banking regulations developed by Basel Committee on Banking Supervision. In the first video, I told you why Basel Accords are introduced. While playing a role of financial intermediary, banks every now and then facing risks, and because of risks may incur a loss leading to a failure of the bank. So to address these risks, Basel Accords were introduced. In this second video, I briefed about what is Basel I, what is Basel II, and what is the basic difference between Basel I and Basel II. Friends, in Basel I, only credit risk was taken into consideration. But in Basel II, credit risk, market risk and operational risks were taken into consideration while weighing the risk weightage of asset. Then simple risk weightage was there. 5 broad categories were introduced in Basel I. Asset carrying 0 risk, 10% risk, 20% risk, 50% risk and 100%. Whereas in Basel II, 3 pillars were introduced: minimum capital requirement to absorb the losses, supervisory review for regulatory monitoring and guidance, and market disclosure to ensure transparency. Transparency means to ensure the proper reporting of the banking reports and the risk management practices going in the bank. Friends, in Basel III, a standardized approach was introduced. As a result, external credit rating was made necessary. So friends, we will discuss now what is Basel III. Basel III was introduced in 2010 to be implemented from 2013 to 2019. In Basel III, minimum capital equity was increased from 2% to 4.5%. Now, what is this common equity? Common equity means pure capital, share capital, retained earnings, minus intangible assets. Then additional capital buffers introduced, capital conservation buffer to the extent of 2.5%. Counter-cyclical capital buffer was introduced to the extent of 2.5%. Now this counter-cyclical capital buffer will be taken into consideration when a banking organization is going excessively for credit. It means when there is excessive credit, risk will be more, and to address this risk arising out of this excessive lending, counter capital buffer is to be done to the extent of 2.5%. Basel III introduced 2 liquidity requirements: liquidity coverage ratio and net stable funding ratio. This liquidity coverage ratio will take care of the short-term obligation and net stable funding ratio will take care of the long-term obligation. Risk-based capital requirements. In Basel III, the risk-weighted assets calculation was refined to better reflect credit risk. Systemically important financial institution. Systemically important financial institution means a big institution, and for these institutions introduced additional capital requirements. Also in Basel III, macro-prudential policy was introduced to address systemic risk. In context of Basel III, systemic risk is very important. Now, what is the systemic risk? Systemic risk refers to the risk that a financial institution's failure or distress could trigger a broader instability in the financial system, potentially leading to widespread economic harm. I will repeat. Systemic risk refers to the risk that a failure of financial institution or distress could trigger a broader instability in the financial system, potentially leading to widespread economic harm. The key difference between the Basel II and Basel III: Basel III increased minimum capital requirements and introduced additional capital buffers, capital conservation buffer and counter-cyclical capital buffer. Liquidity requirement introduced new liquidity requirement, liquidity coverage ratio and net stable funding ratio. But in Basel II, there was no mention of liquidity, additional liquidity requirement. Risk-weighted asset, Basel III refined the risk-weighted asset calculation to better reflect credit risk. Basel III introduced additional measures to address systemic risk, including the capital requirement for the CP, systemically important financial institutions. These changes aimed simply to strengthen the resilience of banks and to increase the ability to withstand financial shocks. Now, what is this resilience? Resilience refers to the ability of an individual or organization to withstand to adverse situation challenges. You can say in case of financial resilience, the ability of a bank or financial institution to absorb financial shocks, maintain stability and to continue operate effectively. Common equity tier 1 capital. Common equity tier 1 capital 4.5% of risk-weighted asset. As I told you, common equity tier 1 capital means a pure capital. This includes common shares, retained earnings, disclosed reserve minus intangible assets. And tier 1 capital consists of common equity tier 1 capital and additional tier 1 capital instrument like contingent convertibles. Now, what are these contingent convertibles? In fact, basically they are bonds, but they can be converted into share into capital where a capital level of an organization goes to a lower level. Then tier 1 capital, total capital, minimum total capital 10.5% of risk-weighted asset, 8% minimum plus 2.5% capital conservation buffer. And total capital definition means tier 1 capital and tier 2 capital. Tier 2 capital means like subordinated debt. Now, what is subordinated debt? Subordinated debt, also known as subordinated loan or junior debt. This is a type of debt that ranks below senior debt in terms of priority in the event of bankruptcy or liquidation. I will repeat, subordinated debt is a subordinated loan or a junior debt is a type of debt that ranks below senior debt in terms of priority in the event of bankruptcy or liquidation. Friends, Tier 1 capital and total capital means Tier 1 capital, Tier 2 capital. This we are already discussed. So friends, I hope you must have loved this video, and as I told you, I am going to tell details about the Basel III. This is my third video. In the fourth video, I will discuss about capital conservation buffer, benefits of capital conservation buffers, objectives, then counter-cyclical capital buffer, what is the objective, how it impacts. So with this, I am concluding here. I wish you all the best, and I hope if you like this video, please like it, please subscribe it. Thank you very much.